What if I told you that inflation is once again flooding the Eurozone and in many countries it's rising far faster than the interest rates meant to stop it? Just look at the numbers. In Greece, inflation has climbed to 5.2%. That may sound bad enough, but just 1 month ago it was sitting at a shocking 5.8%. Croatia and Lithuania have also pushed above the 5% mark, showing that prices pressures are spreading across multiple parts of Europe. But the real record holder is Bulgaria, where inflation has surged to 6.9%, making it one of the hottest inflation environments in the European Economic Area. And it's not just the traditional weaker economies. Even countries known for more stable public finances are seeing inflation run far above comfortable levels. Belgium is at 4.08%, the Netherlands at 3.5% and Ireland at 3.6%. Now here's where things get worrying. The European Central Bank's key interest rate stands at just 2.4%. In other words, in most of those countries, inflation is significantly higher than interest rates. That means the real value of saving is still being eroded, borrowing costs remain relatively low compared to price growth, and the ECB may be losing the battle against rising prices. So the big question is this: is Europe heading into a second inflation wave, just as many people thought the crisis was over? Why inflation is surging across much of the Eurozone? A quieter but equally important trend is beginning to emerge outside the euro area. In countries that do not use the euro as their national currency, ordinary people are increasingly questioning whether holding euros still makes financial sense. Across countries such as the United Kingdom, the Czech Republic and Poland, savers have traditionally viewed the euro as a relatively stable store of value, but today the perception is starting to change. The problem is simple. Inflation across many Eurozone countries is running far above the European Central Bank's interest rates of just 2.4%. That means anyone holding euros is effectively losing purchasing power year after year. Even if their money remains in the bank, the value of those savings is being eaten away by rising prices. Meanwhile, many non-euro currencies offer significantly higher interest rates. Savers can often earn better returns by holding local currencies rather than euros. In some cases, these currencies are not only paying higher interest but also appreciating against the euro itself. This creates a double advantage. Investors receive higher yields on their deposits while also benefiting from a strengthening exchange rate. As a result, some households and investors are gradually reducing their exposure to the euro and shifting part of their savings into currencies they believe offer better protection against inflation. This trend may not be visible on the streets, but it is becoming increasingly important in financial markets. Because every time investors move money away from the euro, they increase pressure on the currency. And if inflation remains elevated while interest rates stay relatively low, the pressure could continue to grow. The euro was designed to be one of the world's strongest currencies. But today, many Europeans living outside the Eurozone are asking a difficult question: why hold a currency yielding just 2.4% when inflation is running at 4.5%, 5% or even 7% in some parts of Europe? The challenge for the European Central Bank is becoming increasingly clear. If the ECB fails to raise interest rates high enough to bring inflation under control, the euro could become less attractive not only to global investors but also to millions of people living across Europe. Think about the choice facing an ordinary saver. Why keep money in currency yielding only 2.4% when inflation in many European countries is running well above that level, even 5%? For British savers, the answer may be simple. The British pound currently offers interest rates of around 3.75%, substantially higher than the euro. Czech households face a similar calculation. The Czech koruna offers interest rates of roughly 3.5%, making it a more attractive option for those seeking to preserve the value of their savings. In Poland, the incentive can be even stronger. Polish savers can earn around 3.7% on assets denominated in zloty, compared with only 2.4% in euros. From an investor's perspective, this creates a powerful motivation to avoid the euro. The higher the interest rates advantage, the greater the reward for holding alternative currencies. And the competition does not stop within Europe. Investors looking for even stronger returns can turn to some of the world's major reserve currencies. The US dollar offers interest rates of around 3.75%, making it significantly more attractive than the euro from a yield perspective. Meanwhile, the Australian dollar stands out even more. With interest rates around 4.35%, it offers nearly double the return available on euro-dominated assets. This means that unless the ECB acts decisively, capital could continue flowing toward currencies that offer both higher yields and better protection against inflation. The danger for the Eurozone is that investors may begin to see the euro as a low-yield currency trapped between weak growth and stubborn inflation. And once that perception takes hold, restoring confidence becomes far more difficult. For the ECB, the message from the market is straightforward. If inflation remains above target while interest rates remain well below competing currencies, the euro risks losing both purchasing power and investor demand at the same time. So what happens if inflation in the Eurozone remains significantly above interest rates, the euro continues to weaken against other currencies, and the ECB refuses to raise rates enough to restore confidence? A first consequence would likely to be a continued outflow of capital from the euro. Investors generally seek the best combination of safety, yield, and purchasing power protection. If euros offer lower returns than competing countries while also losing value to inflation, many investors could move funds into pounds, dollars, Australian dollars, Czech koruna, Polish zloty, and other higher yield currencies. As more capital leaves the euro, the currency itself could come under increasing downward pressure. A weaker euro would then create a second problem. Europe imports enormous quantities of energy, raw materials, industrial components, and consumer goods from outside the Eurozone. Since many of these products are priced in the US dollars, a weaker euro means higher import costs. Those higher costs would eventually be passed on to consumers. In other words, a failing euro could actually create even more inflation. This is one of the most dangerous economic feedback loops. High inflation weakens confidence in the currency. A weaker currency makes imports more expensive. More expensive imports push inflation even higher, and higher inflation further weakens confidence. If this cycle continues long enough, real wages could come under severe pressure. Even workers receiving pay rises may discover the prices are rising faster than their incomes. Households would gradually lose purchasing power. Savings would buy less each year, and consumer confidence could begin to deteriorate. Businesses would face growing uncertainty as well. Companies would struggle to forecast costs, negotiate long-term contracts, and plan investments. Some firms could postpone expansion projects or hiring plans until inflation becomes more predictable. Governments would not escape the consequences either. Higher inflation often increases pressure for public spending, wage adjustment, and social support programs. At the same time, weaker economic growth can reduce tax revenues. This combination could place additional strain on public finances across the continent. The most serious risk is that inflation expectations become permanently embedded in the economy. Once businesses and consumers start assuming that higher inflation will continue for years, they change their behavior. Workers demand larger wages increases, companies raise prices more aggressively, and inflation becomes harder to bring down. At that point, the ECB would eventually be forced to act much more aggressively than it would have needed to act earlier. Instead of moderate rate increases today, policymakers might be forced into much larger hikes later. Such a delayed response could increase the risk of recession, financial stress, and a sharp slowdown in economic activity. In short, if inflation remains well above interest rates, the euro weakens, and the ECB chooses not to respond, the Eurozone could face a combination of currency depreciation, imported inflation, declining purchasing power, weaker investment, and eventually a much more painful fight against inflation in the future. The longer the ECB waits, the higher the potential economic cost of restoring stability.